Cue the music. Hey, welcome everybody. This is the FIBI chat that we have every Friday here. It is now January 26th, another beautiful Friday here in Southern California. And I'm really excited about the guest I have today because I don't get to see him very much. He's out on the East Coast. He really added a lot to my investor mentality when it comes to notes. His name's Dave Van Horn, and a little bit about Dave. Since 2007, he's served as president and CEO of PPR Note Company. That's a holding company that they manage, several funds, and not only firsts but also seconds of residential mortgages nationwide. He's got, over 30 years of residential and commercial experience. Started out as a realtor, then evolved into an investor and fundraiser. And, Dave has raised over $100 million for both notes and commercial real estate. I bet that number is going up every day because he's very active. I know he's out there a lot, finding opportunities for his investors. He also has a considerable portfolio of residential investment properties and commercial holdings. So I would just want to give a really warm welcome to my good friend, Dave Van Horn. How you doing, Dave?
Good, Alice. How are you doing?
Wonderful. It's like I said, I'm so excited because when I used to run live meetings, it was so hard to get a lot of the experts that I know like you out to see us in the meetings. But now with technology, I can do this on Facebook Live and introduce all these wonderful people like yourself. Tell us what's been going on. I mean, you've been out there, since 2007. You've seen a lot of ups and downs in the market. Tell us what's happening in the note market.
Well, we're pretty much in an up market.
Yeah.
It's a little different this time around. I started out in an up market, and we obviously went through a crash, right? So when we first started out, we were, buying assets with equity, and then next thing you know, you wake up one day and your equity's not there. It wasn't there at the same level, right? And, but there was a good lesson that came out of it, and really the lesson was that equity wasn't always everything. Even though equity is your collateral, it doesn't necessarily dictate the outcome of your asset.
Uh-huh.
And I guess a good analogy would be like if I had a rental property. Now I'm going to use small numbers, and I know you're in California, but I'm doing it for simplicity.
Right.
If I had a $100,000 rental property and it dropped to $80,000, but my rent was $1,000 a month and my mortgage was $700, who cares unless I have to sell the asset, right? So we didn't have to liquidate. We worked through the product anyway, even though the portfolio's value had fallen. But what we learned was we could collect on upside down or partially covered assets, which became very valuable data.
Right.
And then we actually realized we paid a lot for equity. Uh-huh. And then in the future, when we were riding through this down cycle, which was for a pretty long time now, it was for a pretty long time. And then we were able to get assets cheaper and actually sell the equity assets and work the partial equity assets and make more money than if we did when we were just working with equity assets. I hope that makes sense.
Right. I was going to say, let's decode it for all the people that aren't as familiar with notes, because, you and I, we could probably chat all day about this stuff with our.
Yeah. I got off the deep end real quick. Right?
Yeah. So, to circle back, what Dave is talking about is when you're buying notes, kind of the old school way is that you want to have plenty of equity in those notes, but what Dave was saying is that you got to pay a premium for that stuff. If there's a lot of equity in it, the note sellers are going to say, hey, we're going to mark that asset up to a certain degree, whereas there's this whole other pool of notes that maybe have little or on the surface no equity, but what you're saying is that you discovered kind of a hidden value, right? It's a hidden value of, well, gosh, if this thing can rent for so much and you don't have to sell the asset, you could basically hold on and negotiate with that borrower and figure out a way for both of you guys to win, right? They get to stay in the property, you get to figure out a payment strategy and just be really creative with deriving some profit out of it.
So you ended up with statistical data that you wouldn't normally have.
Right.
And then you saw the value in that data and how it proved out. And it was very valuable information later on. But today we're back into equity again.
Mm-hmm.
Now there's, I guess the number one question I'll hear, especially retail note buyers, is,
Right.
there's not as many notes to buy anymore.
Yeah.
But there's a couple things going on to give people perspective. We're in an up real estate market, right? We can all agree to that pretty much across the board. Sure, there's probably some pockets somewhere that are lagging maybe, but the majority of the country seems to be getting back on its feet, or it's at least at the values it was before the crash. And some areas like California are, going off the charts a little. People are actually talking bubble again.
Mm-hmm.
But what we're seeing is that it is different this time around. There's more employment, for example. You still have relatively low rates, even though they've inched up a little bit.
Right.
But when I started in real estate, rates were 14. So
Yeah.
it shows you how old I am, right? But and today it's funny. I'll hear the young folks are like, "Oh, the rates just went from 4.5 to 5, or 4 to 4.5," and they're panicking, right? I'm like, "Are you kidding?"
You got to hold your reaction in, right? Because it's like coming from the double digits. Yeah.
So I think I know interest rates rising puts downward pressure on real estate values, but if you notice, we're really not seeing that quite like that yet, even though they've been inching up.
Right.
And I think, that'll be yet to be seen, but I think, in the short term, I still think these real estate values going up is increasing the value of the notes, and there's funds selling less notes. They're holding more notes. We hold more notes than we used. It's funny. People go, "Oh, how are you going to sell more notes?" I'm like, "Well, where were you 5 years ago? We were selling everything in the kitchen sink, and you were nowhere around, right?"
Right.
So it is a supply and demand equation to a point. And then it's also an equity-backed investment.
Right.
And you're seeing, the good news is, well, there's good news and bad news, right? The bad news is if I go out to buy product, it's more expensive, right?
Yes.
But my whole portfolio went through the roof too. And I have people cashing me out. And when I get cashed out early, my yields go through the roof. So it's, what am I complaining about? Am I complaining about,
it's a good problem, right, Dave?
It's kind of a good problem, as long as you can get some type of a margin on what you're buying, right?
Yeah.
But to be quite honest, we've bought more product in the last year than we did in the last few years.
Oh, no kidding.
So we're seeing the opposite. Now, we're kind of fortunate because we got big enough in size over the years that we do have access that a lot of folks don't, and we're getting more and more product from the government entities, the GSEs, and the Fannies and the HUDs, and in the old days we didn't have that type of access, right?
Right.
So it's bittersweet that way. Also, there's a lot more compliance, so it's it's harder. Well, I'll put it this way: a lot of the folks selling assets are very leery of who they sell to.
Really?
And because part of that is because they're responsible for the asset. Well, they're responsible for the transfer of data at the time of a sale. So if I sell to someone who's non-compliant, it could create issues, for example.
Gotcha.
That's why, we won't sell to someone without a licensed servicer in place, for example.
Gotcha.
It's because we're responsible. So if I sell Ellis a note and you don't have a licensed servicer, I'm on the hook.
Wow.
For the transfer of data at the time of sale. So do I want that liability? And the answer is no, of course not.
So that's a big game changer.
Like it was years ago. Because think about it, we were an industry that wasn't regulated for the private note folks.
Yeah.
Today it is. You're regulated almost like a bank, so different environment, right?
Yeah, let's for our listeners and viewers out there, let's kind of go back to when we were first starting in this. What made you look at notes? Because you had been doing a lot of other things, and just kind of address that. What made you see the opportunity? What made you say, hey, I want to try this asset class out?
Partly by accident. I was a RE/MAX agent. I was selling investment properties only. I had a title company. I was a property manager. I was selling probably 75 properties a year to investors. And I owned a lot of I had like 40 of my own.
Right.
And I would, what happened was it pretty much dried up. I went to selling 7 houses a year from 75 or whatever.
Yeah.
And it's a finance-driven business, and especially financing for investors kind of went away, right? There's no more any no-doc loans or anything like that. So basically, my one partner was one of my lenders at the time, and I used to run a real estate investment group, and I would interview speakers. And one of the speakers that came to our group one time was a gentleman out of New York who was raising money for distressed debt.
Okay.
Of course, I didn't do anything, but my partner did. And, I guess about 3 years after that, right before the crash, we were like, hey, what side of the fence do we want to be on in this market? And we convinced the person, hey, if you show us how to collect on distressed debt, we'll buy assets from you. And then the rest is kind of history.
Right.
But what I liked about it as an investor was that I felt that if I could buy something at a discount, with a high yield, with collateral, it was pretty appealing to me, So
there's a lot of positive things about having all those things in place. High yield plus collateral. There's a lot of kind of safety nets in place, right?
Yeah, I mean, I used to trade stock options, for example, but there's never any real collateral, right? So you can do all kinds of fancy trades, like a butterfly trade or something, or try to put insurance on your trade. But at the end of the day, you don't have collateral really. So.
Gotcha. So now, you've seen the dip in the market. When you started PPR in 2007, that was when, about a year after the peak in the market, and we started to see kind of the writing on the wall that, something is brewing here and it's not a good thing. But sometimes, when bad things happen, it creates opportunity. So you start this company in 2007, and it's like you said, highly unregulated in a lot of ways, and not a lot of people know what a non-performing note is, and you're in there and you're getting started. And now you have access to all this inventory now because of your growth and because you've stuck with it all these years. What do you have as far as a vision for your company going beyond here, with all the changes?
Well, you'll like this, Ellis. We hope to someday have over $1 billion under management, and we think we're going to do it in less than 10 years.
Oh, wow.
And we're setting systems and things in place to do that. We are also looking at the crowdfunding model. And we're also, our mission today is really to help people, to share, build, and preserve their wealth, right? Whether it's the homeowner who's in trouble, or whether it's our investors or our employees or our other stakeholders. So our goal is to leave everybody we come in contact with or touch in a better place, kind of thing.
Gotcha. Okay. PPR, that stands for something, right? The PPR, I remember.
It was Partners for Payment Relief, which is kind of a name geared towards the homeowner. We're more of a shop that tries to modify more than foreclose, so to speak. We're really not in a model of. Some folks have that model, right? To get the properties, that type of thing.
Right.
Ours is, we're geared more towards occupied loans, and where we're trying to modify. Where as opposed to, there's plenty of folks out there that purchase REOs or they're purchasing vacant, non-performing first, for example, where the intent is more to get the properties, that type of thing.
Yeah. So Dave, when I'm looking at your website, and it's changed a bit since you first started. It's got so much more content, and there's some really great stuff, like a free ebook on how to build wealth with distressed mortgages. But I was wondering, you've got these funds that you've been managing for. I mean, that's got to be quite a benefit to people that say, you know what, this whole thing of non-performing notes or performing notes or just the whole note space can be kind of intimidating, and I just don't have that kind of time, but I want to diversify my assets. So you're offering funds, and you still sell individual notes to people as well. Is that still part of the business?
Yes, we do. We don't sell the volume that we used to. A lot of our funds holding assets here, and there's a reason why. If you hold an asset in this environment, it's actually going up in value doing nothing.
Right.
Because as real estate values continue to go up, the asset becomes more valuable. Also, pay history. So the longer the pay history, the asset becomes more valuable. Now, in a down market or a falling market, the opposite is true. We might be doing the exact opposite. We would be liquidating most of the assets, right? Especially reperforming assets.
Right.
So we're always looking at our fund investors first. They're our first priority because they give us the capital to operate and function and go out and buy product. But we've been doing this for over 10 years and have a pretty good track record at this point. We only raise capital in our funds from accredited high net worth folks.
Right. I was going to mention that. This is for accredited investors only, right?
But anybody can buy a note.
Yeah.
And we push notes out weekly, though. It's not like, we're not frequently selling notes. And we also, our reperforming notes are sold with a warranty, which is investment principals minus payments received. So that's probably another reason that we sell out pretty quickly, or we have a lot of bids on our assets because of the warranty as well. So it's been good to us, and it's good to our fund investors. Now, our fund investors, I think the big advantage for those folks is that, well, here's another thing that happens in the market too, Ellis. Like years ago when we were in a down market, the notes were paying a higher yield than fund investors. And today it's kind of flip-flopped, whereas the funds can actually be paying a higher yield than notes because there's so much demand for the notes. So, but a lot of the fund investors like the fact that it's very passive mailbox money.
Right.
We get a lot of qualified plans. We have a low minimum, things like that. Plus, I think the big advantage for a fund investor is that they're diversified in a portfolio. As long as you believe in the management team.
Right.
Pretty much it's like investing in shares of a non-publicly traded company is really what it is. But the beauty of it is you're diversified amongst the pool of assets. If one went bad, it doesn't necessarily impact your investment.
Right.
And also you have no liability other than your investment. Whereas if say you have a note and you had a third-party contractor did something wrong, you could theoretically be dragged into a suit. And, next thing you know, you're sued for fair debt collection violations or something, or whatever that is. And there are cases where a state regulator could sue you for well beyond the cost of that note, right? So there's some advantages to being in a note fund, especially today, because today we have like a servicing arm with all our licenses and that kind of things.
Yeah, so a good place to go for our audience out there is to check out the website. It's pprnoteco.com, pprnoteco.com. Lots of good stuff in there to get educated and get some good content. You do a lot of blogging, don't you? You're on Bigger Pockets?
Yes, I'm a weekly blogger usually on Bigger Pockets, and I enjoy writing. It's fun to give back and answer questions, and my one son actually got me into it.
No kidding.
Yeah, he's like, Dad, you need to write and do some stuff. I was like, all right. So it's been good.
Yeah. So I remember way back when I was looking at buying more institutional type notes, I wanted to get some more education, and PPR used to do a lot more kind of one-on-one training or mentorship type of thing, and that's kind of been shifted. You've kind of pivoted a little bit away from that. Tell us more about the reason for that.
Well, I think there were a few reasons. One reason was, well, obviously we were getting bigger.
Yeah.
And we're a bigger and bigger fund, and the education piece and the coaching was somewhat time consuming. And then the other side of it was, we weren't always selling a lot. Sometimes we'd hold notes, sometimes we sell notes, but then a lot of it became compliance. A lot of it, and the regulations would vary so much from state to state. It became harder and harder to teach it effectively.
Right.
And you don't want to see students getting in trouble out there doing the wrong thing in the wrong state, and it started to become more and more cumbersome in that regard. So we still have some educational materials for folks that want to, but the actual, long time ago, we used to give you a note and coach you through it and walk you through it. And,
I love that. I used to love those calls because I would get on there and I would learn so many different, it was interesting because I actually had a better game plan before I picked up the phone because of those calls. I said, okay, here's what I'm trying to accomplish. Whereas before I was just trying to kind of feel my way through a conversation with the borrower. But your stuff was top notch. It's, I understand how, with a shifting environment, how that had to change. But I really value that binder and all those CDs that I got from you guys.
Well, there's a lot of complexity today, but you're right. As it became more and more regulated, it became harder and harder to teach it, and we don't want to see folks get in trouble with it either. Non-performing notes today is a little bit different. It's definitely a different ball game, especially with owner-occupied.
Doesn't it?
from a regulatory perspective, there's definitely some inherent risk there that I don't know that a lot of folks are totally aware of all the time.
Mm-hmm.
Now, it varies from state to state, but
Right.
there's actually probably close to, could be a dozen states at this point that want licenses just to own a note or buy a note.
Right.
And so it starts to make it pretty, harder and harder to do the business, especially for the little guy. I actually feel for the little guy because it's hard to get into the space. I think we were just lucky we got in when we did, got big enough that when it all came in, we were able to still hang around, so it's,
Yeah.
But we've invested a lot of money in servicing and licensing, a lot of money, and in software too.
Yeah, I remember when we had our note camp many years ago over at a good friend of ours at Ranch, and one of the things that really stuck out was that PPR was really putting a lot of emphasis on systems and things like that. Because what did you say to me? You said there was a saying. You said if you had unlimited capital, how many notes could you handle, or something like that. Do you remember that?
Yeah, scalability question. Yeah. It's if all the notes were free, how many could you handle?
That's it. Yeah.
Unlimited amount of money, how many notes could you buy?
Yeah, I love that. That still rings in my head about if all the notes were free, how many could you handle? And that it's always the power of the question, asking the more powerful questions that really transform you. So
you can do that with a lot of things, like you do with houses too. You say how many houses could you rehab if you had unlimited capital?
Right. So it's a very powerful question that I remember to this day. So you've been doing a lot of blogging. You're also pretty excited about hearing about this. You have an upcoming book that's going to be published as well. Tell us a little bit about that.
Yes, it's actually it's called Real Estate Note Investing.
Okay.
A niche strategy for all investors, which is kind of an oxymoron. But the book's a little different this time. It's more geared towards the real estate investor.
Okay.
And it's also covering every aspect of notes from your student loan to your credit card to it's really a whole global look at basically finance, leverage, OPM, and how I kind of morphed personally. Part of it's the story of throughout my life, how everything from my first note all the way through to utilizing other people's money to how you can really, it comes down to this: you don't necessarily have to own 100 houses or 1,500 houses or whatever. You can, if you incorporate some of the finance strategies and some of the finance hacks that are out there, that you can really accelerate your wealth building and have a more balanced or simpler life sometimes than that type of strategy. And I kind of walk through a lot of those strategies. It's a book on strategy a lot of times,
That sounds really valuable. So you're basically sharing your 30 plus years of wisdom on understanding debt and how to utilize it more effectively for a lifestyle.
Yeah, I mean it was a great book to write. I did a lot of the work with my son. There's a lot of case studies in there. And he knows a lot of my story already, but it's a great book that I can leave my two sons, and I have 3 grandkids right now, so I can leave them. They can say, this is what Pop did and how he did it, and it's kind of fun that way. They can see some good lessons in there, I hope.
Right.
And I think it's great to share with other people too, because they're all mostly wealth building type strategies or finance hacks that would hopefully they can get some lessons out of and put it towards their life in some way,
Right. So that's coming out, you said, in April?
Yes, and probably the first or second week of April should be out.
Can you give us kind of maybe a tidbit of a hack that is in the book? You don't have to give us the full thing, but maybe give us a highlight about something you think would be particularly inspiring or helpful to someone.
Well, there's a lot. There's a whole bunch of them. Probably one of the most popular hacks I have isn't in the book, I don't think, and it was how I paid for my son's college for a third of the money.
Oh my gosh!
That
gets my attention because I got 3 that are going to go.
That gets everybody's attention, right? Yeah. So really, it stems from the theory of your assets paying for your liabilities.
Nice.
It's the premise, right?
Wow.
So a lot of people don't necessarily have that mindset. I was one of them.
Right.
And I changed my mindset to, it would be almost like my vacation homes. I mean, my rental properties pay for my vacation home. Or if my wife wanted a car, I would go out and buy a cash flowing rental property, or I'd go
Oh,
buy a note, and the
okay.
payment from that, or the cash flow from that, would pay the payment on the car. Like I would never go into my pocket and buy a car or anything.
Right.
So, it's really about your assets paying your liabilities. There's three stories I tell usually. One is I have a friend who put an addition on his house,
Uh-huh.
and what I told him, he took a home equity line of credit on his primary to put the addition on.
Right.
And I said, why don't you get extra money on the line of credit and you'll buy a note with that? So
Okay.
that's what he did. He got enough money to do the addition, took out some extra capital to buy a note, and the payment from the note paid for the addition, and he actually got a free addition.
Oh, no kidding.
So a
Wow.
lot of people don't think like that, right? So
Yeah.
so then another, along the same lines, I do from insurance. I used to have an insurance license. I don't practice insurance today,
Uh-huh.
but I had a license years ago. And another strategy, a builder taught me that. Years ago, I was in construction, and the builder would borrow money out of a policy, build the house, sell the house, make 7,500 grand on the house,
Right.
pay the policy back, and what you get free insurance basically, and then some. Well, I took that same idea to my investors and my clients that are in my fund, for example, and we teach these types of strategies to our high net worth folks and stuff.
Mm-hmm.
So it would be like this, Ellis, if you never pay for insurance out of your pocket, and insurance should be a bank and a safe bucket for you.
Okay.
And a lot of people pay their insurance out of their hard-earned dollars, but my strategy is no, overfund the policy, borrow some money out. Whether you buy a note or a piece of real estate, you could buy a note, and the payment from the note would pay back the loan and the premium, and you would get cheap or low-cost insurance, right? So
Right.
Hopefully you can follow that.
I do. I think what it's really about is shifting your philosophy about how you see all the moving pieces of money and assets, and then having them kind of dance together in a different way, right? It's
Right.
really a shift of mindset.
So now I'll get to the good one, right? So this
Yeah,
is
yeah.
really the same. This is the same idea, and this is
Yeah.
only one hack, and I talk about many hacks in the book. This is just one.
I can't wait for that book, Dave. You've already got me salivating.
So this one's on college, and this is a good one. And I don't think this is in the book. I don't think I put this in the book. So my son was ready to go to college, and he's like, Dad, you got some money. Why don't you just write a check and pay for my college? And I go,
Nah.
Nah, that's not how it works.
Right.
So he goes, the funny part was, I go, I got a better idea. You're going to take out a student loan. I'm going to actually have your mom take out a student loan. And he goes, well, I don't understand why we're taking out a student loan when I know you could just write a check. I go, because it's like free money. I go, I can get a student loan easier than I can get a mortgage.
Wow.
So student loans at the time were, I forget, 6 or 7%, but just
Yeah.
play with the game.
Right.
Obviously, I can do private money, hard money,
Right.
15%, whatever it is, 13%, 18%, whatever you can do.
Uh-huh.
Notes, similar. I could get decent yields on notes, right? Just so people know that there's vehicles out there that obviously pay a higher return than the student loan.
Right.
And a lot of these types of loans can be deductible sometimes under a certain income level, whether it's your student loan or your HELOC. Now, HELOCs are a little different today with the new tax law, but you get the idea.
Yeah, so you're basically looking for opportunities to work the spread, right? You can borrow at it cheaper than you can earn, so.
So it's a lesson in interest rates for my son. It's a lesson in arbitrage. It's a lesson in responsibility because I want my son to have skin in the game.
Yeah.
Show up for class.
Right.
Get done class. Realize it's his credit. He's got to get a job. He's got to pay it back. So these are all good, valuable lessons for my son. Anyway, I thought.
Mine too.
So here's where it gets kind of fun. So normally, if I had reached in my own pocket and paid for college, that money would have had to come from somewhere, and it would have probably came from my investment money that normally would have been invested.
It's working
so I had
for
to
you.
pull it
right?
out of investments to pay for college, right? So
right.
instead of doing that, I took the bank's money,
Yeah.
used their money to pay for college, and kept my money working, making more money. So there's a spread there, right?
Right.
And when you factor in 4 years and 6 months of deferral, I got 4.5 years of sometimes not having to make payments. Now, on a parental loan, you might have to pay as you go, but you get the idea.
Right.
So I'm making money on the spread the whole time he's going, almost to the point where I almost wish he stayed in school, Alice. But
yeah, keep that money coming, right?
right. So I'm making that arbitrage. But then here's where it gets good. So he gets done college, and at the time he was actually working in PPR. So he says to me, the 6 months is almost up. He's getting a little nervous, and he's like, "Yeah, I thought you were going to show me how to pay this thing back." So I said to him, "Well, how much money do you have saved up?" And it was, I think it was around $5,000 or whatever he had saved up. I go, "Well, let me see what I can do." So we ended up getting a note, and we bought a note for about a third of what he owed. And I think he owed like, I don't know, 15 or 17 grand. I forget what he borrowed.
Okay.
And the cool part was the payment on the note would pay the payment on the student loan. So he was able to buy a discounted note where the payoff was actually about the same as the note. And it actually had a longer term. It was actually, I think his student loan was 10 years, and this was longer than that. It was 12 or 15. I forget what it was.
Right.
So now the payment from the note is paying the loan back for a fraction of the money. So whether it was 30 or 40% of what was owed, we were able to pick up a discounted note. Plus you had the arbitrage while you went. So you paid, I don't know, a quarter to a third of what you normally would have paid for college.
Wow.
If that makes sense.
It does. And then since it had a longer term, so after he already paid off the note, that thing's still paying him, right?
That thing's still paying him. So here's where it got interesting. Here's where it got really good. Yeah. So he wanted to be in film. He's moving to LA. I'm driving him down to the Philly airport.
Yeah.
And I hand him an envelope, and he goes, "What's that?" And I go, "Well, that's the money for the note. I don't want you to tell anybody your old man didn't pay for college."
That's beautiful.
And I don't want to tell you what he said at that point. So here's how I know the lesson stuck. So he moves to LA.
Yeah.
And he has this used car that he shipped out to LA.
Okay.
And about a year goes by, or a year and a half, the car goes. So he calls me up one day, and guess what he says?
What did he say?
"You have any of them short-term notes laying around? I need to get a car." And I was like, "That's perfect."
You taught him well.
So here's the car story in a nutshell, real quick.
Yeah. So
he had, I go, "How much you got saved up?" And it was like, he had like $4,500 or something. I go, "What's the matter? You can't save more than $5,000?" So he saves up the money. I get a short-term note. It was like a 7-year note. And don't you know, he had enough cash flow from that note. It was like, I don't know, 290 or 310 or whatever it was. He was able to buy a lease, a brand new Prius.
Nice.
So he got a 3-year lease on a Prius. He did it another like 3 years. So he got, and then it was a 7-year note. So he actually, for the money of a used car, which would have been somebody else's nightmare, right?
Right.
He was able to get a brand new wheel and drive around LA in a Prius and look like everybody else in Southern California.
Yeah. So now he has a note kind of supporting his lifestyle, right?
So so this is what I'm, but the thing is, he's in his early 20s at that time. Now he's going to be 28. But you get the idea. He learned that, hey, my asset is paying my liability, and it's just a different mindset. And for somebody in their early 20s to think like that is a valuable lesson.
That's huge.
And I do stress we should do more stuff with our children. Like, so, even when he was younger, I had him trading options with me. I used to pay him to do my taxes with me.
Wow. And
my tax returns were pretty involved. Not that I did them myself. I would take them to an accountant, but just getting everything ready.
Understanding
and it was a valuable lesson especially for estate planning. He's actually very well dialed into the family businesses and entities, and he's a valuable resource for the family now. And it's great. I even do that with my grandson. My one grandson's 11, and we'll play cash flow for kids since he was like 6.
Right.
And then I'll even drive him out to where my oldest son has a painting company, and I'll take him out to sometimes his father might be working on one of my properties, and I'll say, here's where Dad's working. This is how Pop-Up's making money. Remember the game we just played? Here's how much rent we collect. Here's how much, and my grandson gets it.
He's connecting all the dots, right? Because all that stuff.
Yeah, they know money. Trust me. And then he'll pick up like a card on the board, and he'll be like, "Hey, Pop-Up, is this gonna make me money?" And I'm like, yes or no or whatever. So it's interesting. That they're not too young most of the time, so.
Yeah. I think we underestimate our kids on what their capacity to learn, because if you bring it to them in a very creative way, I think they'll latch onto it. Yeah, so
it's a lot of fun.
Yeah. I took my oldest son to a financial calculator class where he had to run, future value and all that stuff. And then, he knows that I'm a note buyer, so I always run him through my note transactions. So he gets it.
Yeah, it's great.
Yeah, yeah. So I love that. We should maybe schedule another time again to talk more about that because I love this subject. It's something I'm very passionate about.
Yeah, the kids thing is a big thing. I had a real good friend when I was selling a lot of real estate. He would bring his two sons to every closing, every business meeting, every accountant, attorney meeting. And his two sons today are the brightest young men I've ever seen because they've been to so many transactions and deals that make your head come off.
I believe it. Now, speaking about education, I know that there's a big conference coming up, the Mid-Atlantic Real Estate Summit. Tell us a little bit about that.
Summit,
yeah.
MidAtlanticSummit.com. It's an East Coast event. I got the idea from a buddy of mine, Jay Martin, who does this in the Bay Area, in San Francisco, Oakland area. And he's done it, I guess, 3 of the last 4 years. And I've, been fortunate enough to go out there and speak. And I took this idea east, and really it's no selling, no pitching.
Right.
And we bring in a lot of topics and a lot of speakers, and it's a good time is what it is, and a lot of fun. And, the people in the audience are as smart as the speakers and vice versa. And it's good. It's a good community type event. And we're like donating all the proceeds to this homeless charity in Philadelphia and Detroit, and
that's terrific.
It's exciting. We're not really doing it necessarily for money or anything like that, other than just having a good educational knowledge sharing type thing, almost like we do online at Bigger Pockets, where we share in the forums and that type of thing. So.
Yeah, I was just kind of glancing through the lineup. You've got Joe Fairless, who's a speaker. He's a huge podcaster and investor as well, and some names that I don't recognize it right off, but when I read their resume, I mean, these are some really knowledgeable folks.
Oh yeah, Jay Scott's a pretty famous guy.
Oh, Jay Scott, yeah.
I have one buddy that's coming from Memphis. He owns 1,500 houses.
Oh my gosh!
Some of these guys are pretty heavy hitters. Yeah.
So people could find out about that by going to MidAtlanticSummit.com. That's going to take place in the beautiful city of Philadelphia on April 21st through the 22nd. Yes. And I was just talking to Dave earlier before we were broadcasting about when I was in college. I had a roommate, and he introduced me to the trifecta of Philadelphia. I was introduced to Scrapple, cheesesteaks, and what was the third? Tasty cakes. So I had the trifecta. So it'll be a good time. So
Scrapple's
if you can,
real good food.
yeah, we're not condoning that. We're just
that's heart-stopping.
Yeah. So if you want more information and want to come out, there's going to be a lot of great opportunities to learn and just to kind of connect with other investors. Hey, Dave, thanks so much. I'm so happy that we were able to do this, and I'd love to do this again. Thanks for sharing your knowledge and information about your company. And your website again is pprnoteco.com. And we're going to wrap this up. So, hey, thanks very much, everyone. We're going to be reposting this on YouTube and podcasting this as well. So I just want to say, hey, have a nice, safe, wonderful weekend, and good luck to the Eagles on the Super Bowl next weekend.
No, that's great. I hope they win.
Yeah,
Thanks,
yeah.
Ellis.
All right,
Awesome.
Take care.
Yep.
So we're going to go out with a little music here, and we'll bring you out. Hold on a sec.